Are you ready to transform your financial future? Many people think investing is complicated, but it doesn't have to be. Did you know that about 70% of Americans don't have a long-term financial plan? Even more shocking, only 20% of investors actually beat the market over a decade. In this video, we're diving into 12 powerful investment principles from The Only Investment Guide You'll Ever Need by Andrew Tobias. You'll discover simple yet effective strategies that can boost your returns and secure your financial future. We'll cover everything from mindful money management and the power of simplicity, to risk reversal techniques and the magic of compounding. Plus, we'll reveal how to build a future-proof portfolio, dominate with dividends, and make your investments work for both your wallet and the world. Stick around and learn how to make smart, confident investment choices. These principles aren't just for the pros, they're for anyone who wants to see their money grow. Let's get started and unlock the secrets to investment success. 1. Mindful money mastery. Investing is as much about mindset as it is about money. A mindful approach can transform your financial future. In The Only Investment Guide You'll Ever Need, Andrew Tobias emphasizes the importance of being present and aware. Did you know that only 30% of Americans have a long-term financial plan? This lack of planning can lead to financial instability. Start by setting clear, achievable goals. Write them down and review them regularly. One effective strategy is the SMART goal method: specific, measurable, achievable, relevant, and time-bound. For example, instead of saying, "I want to save money," say, "I want to save $5,000 for a down payment on a house in 2 years." Another key principle is understanding your risk tolerance. Are you comfortable with high-risk, high-reward investments, or do you prefer safer, more stable options? Your comfort level will guide your investment choices. It's important to be honest with yourself here. Mindful investing also involves regular check-ins. Don't just set and forget your investments. Review your portfolio at least quarterly. Adjust as needed to stay on track with your goals. Remember, the market is dynamic, and your strategy should be too. 2. The power of simplicity. Simplicity can lead to extraordinary results in investing. The book emphasizes keeping things straightforward. Complicated investment strategies often fail. Warren Buffett, one of the world's most successful investors, famously said, "The stock market is designed to transfer money from the active to the patient." A simple approach can be surprisingly effective. For instance, index funds are a great example of simplicity. They offer diversification without the need for constant management. Did you know that over a 15-year period, about 90% of actively managed funds failed to beat the market? Index funds often outperform them because of their low fees and broad market exposure. Another simple strategy is the buy and hold method. This involves purchasing stocks or funds and holding onto them for a long time. It reduces transaction costs and avoids the pitfalls of trying to time the market. Historically, the S&P 500 has returned an average of about 10% per year. Holding an index fund tracking the S&P 500 can yield substantial returns over time. Simplifying your investment strategy also means avoiding unnecessary debt. High-interest debt, like credit card debt, can erode your investment gains. Pay off high-interest debts first to free up more money for investing. 3. Risk reversal techniques. Managing risk is crucial in investing. It's about turning potential pitfalls into opportunities. One effective risk management technique is diversification. Spreading your investments across different asset classes can protect you from significant losses. Andrew Tobias states, "Diversification is the only free lunch in investing." Consider this. If you invest in a single stock and it tanks, you could lose everything. But if you spread your money across stocks, bonds, and real estate, a loss in one area won't wipe you out. Data shows that a diversified portfolio typically yields more stable returns. Another technique is to invest in defensive stocks. These are stocks of companies that tend to perform well even during economic downturns. Utilities, healthcare, and consumer staples are examples. For instance, during the 2008 financial crisis, utility stocks fell by only 25% compared to the 37% drop in the S&P 500. Stop-loss orders are another tool for managing risk. This involves setting a price at which you will automatically sell a stock to prevent further losses. It's a way to ensure you don't let emotions dictate your decisions during market dips. 4. The magic of compounding. Compounding is one of the most powerful principles in investing. Albert Einstein reportedly called it the eighth wonder of the world. The idea is simple. You earn returns on your initial investment, and then you earn returns on those returns. Over time, this can lead to exponential growth. To illustrate, let's say you invest $1,000 at an annual return of 7%. After 1 year, you have $1,070. The next year, you earn 7% on $1,070, not just your initial $1,000. Over 30 years, your $1,000 can grow to over $7,600. Starting early can magnify the benefits of compounding. If you start investing at age 25 instead of 35, the difference in your portfolio at retirement can be substantial. For example, investing $200 a month at a 7% return from age 25 to 65 can grow to over $500,000. Starting at age 35 yields just over $240,000. Reinvesting dividends is another way to harness the power of compounding. Many companies offer dividend reinvestment plans, DRIPs, allowing you to buy more shares with your dividends. This increases your holdings without additional out-of-pocket investment. 5 Behavioral finance hacks. Understanding the psychology behind investing is crucial. Our brains can trick us into making poor decisions. Behavioral finance explores these psychological traps and how to avoid them. Andrew Tobias mentions that recognizing these traps can save you a lot of money. One common trap is herd behavior. People tend to follow the crowd, even when it's not the best decision. For example, during the dot-com bubble, many investors bought tech stocks just because everyone else was. When the bubble burst, they lost a lot of money. To avoid this, do your own research and trust your analysis. Overconfidence is another trap. Many investors overestimate their ability to predict the market. This often leads to excessive trading and higher costs. Studies show that frequent traders earn less than those who trade infrequently. Keep your trades to a minimum and focus on long-term goals. Loss aversion is also a major pitfall. People hate losing money more than they enjoy gaining it. This fear can lead to selling investments at the wrong time. It's important to stay calm during market downturns. Remember, the market historically trends upwards over time. 6 Diversification dynamics. Diversification is a cornerstone of smart investing. It spreads your risk across various assets. Andrew Tobias calls it the only free lunch in investing. By diversifying, you protect yourself from the volatility of any single investment. One way to diversify is to invest in different asset classes. This includes stocks, bonds, and real estate. Each class reacts differently to market conditions. For example, when stocks go down, bonds often go up. This balance can stabilize your portfolio. Another strategy is to diversify within asset classes. Don't just buy stocks from one industry. Spread your investments across sectors like technology, healthcare, and consumer goods. If one sector suffers, others may thrive. This reduces the impact of a downturn in any single area. Global diversification is also important. Invest in international markets to hedge against local economic issues. For instance, while the US market might be struggling, Asian or European markets could be performing well. This global spread can provide more stability. 7 Fee-free fortunes. Fees can eat into your investment returns significantly. Even small fees add up over time. Andrew Tobias emphasizes the importance of minimizing these costs. Did you know that a 1% fee can reduce your retirement savings by almost 30% over 30 years? One strategy is to choose low-cost index funds or ETFs. These funds typically have lower fees than actively managed ones. For example, the average expense ratio for index funds is around 0.09%, compared to 0.78% for actively managed funds. Over time, these savings compound, boosting your returns. Avoid frequent trading to minimize transaction costs. Every time you buy or sell, you pay a fee. Stick to a buy and hold strategy to reduce these costs. Research shows that less active investors often outperform those who trade frequently. Another tip is to be mindful of account fees. Some brokers charge maintenance or inactivity fees. Look for brokers with no or low fees. Many online brokers offer commission-free trades and no account minimums, making it easier to keep more of your money. 8 Tax-efficient tactics. Taxes can take a big bite out of your investment returns. But with smart planning, you can minimize this burden. Andrew Tobias offers several strategies for tax-efficient investing. One approach is to use tax-advantaged accounts. Contributing to IRAs and 401ks can reduce your taxable income. For 2023, You can contribute up to $6,500 to an IRA and $22,500 to a 401k. These contributions grow tax-deferred or tax-free, depending on the account type. Consider tax-efficient funds. Index funds and ETFs tend to generate fewer taxable events than actively managed funds. This is because they have lower turnover, meaning fewer trades are made within the fund. Lower turnover translates to fewer capital gains distributions, reducing your tax bill. Tax loss harvesting is another powerful strategy. This involves selling investments at a loss to offset gains elsewhere in your portfolio. For example, if you have a $1,000 gain from one stock and a $1,000 loss from another, the two can cancel out, reducing your taxable income. You can even use losses to offset up to $3,000 of other income each year. 9. Future-proof portfolios. Building a resilient investment portfolio is essential for long-term success. You need to prepare for market volatility and economic downturns. Andrew Tobias advises creating a diversified portfolio that can withstand market fluctuations. One strategy is to include a mix of asset classes. This could mean balancing stocks, bonds, and real estate. For example, during the 2008 financial crisis, real estate investments dropped less than stocks. This balance helps cushion your portfolio against severe losses. Investing in high-quality stocks is another way to future-proof your portfolio. Look for companies with strong financials, consistent earnings, and a history of dividend payments. These companies tend to be more stable during economic downturns. For instance, Johnson & Johnson has consistently paid dividends for over 50 years. Adding defensive stocks to your portfolio can also help. These are companies that provide essential goods and services, such as utilities, healthcare, and consumer staples. They tend to perform well even during economic downturns. For example, utility stocks often remain stable because people still need electricity and water. 10. Dividend domination. Dividend investing can provide a steady income stream and long-term growth. Andrew Tobias highlights the power of dividends in boosting your returns. Did you know that dividends have accounted for about 40% of the S&P 500's total returns since 1930? One strategy is to focus on dividend aristocrats. These are companies that have consistently increased their dividends for at least 25 years. Examples include Coca-Cola, Procter & Gamble, and ExxonMobil. These companies are often financially stable and reliable. Reinvesting dividends is a powerful way to compound your returns. Many companies offer dividend reinvestment plans, DRIPs, that automatically buy more shares with your dividends. This increases your holdings without additional out-of-pocket investment. Another approach is to look for high-yield stocks. These stocks pay higher than average dividends, providing a significant income stream. However, be cautious and ensure these companies have solid financials and can sustain their dividend payments. A high yield can sometimes indicate financial trouble. 11. Timing is everything. Timing the market can be tricky, but understanding market cycles can help you make better decisions. Andrew Tobias emphasizes that while timing is challenging, it's crucial to recognize market trends and cycles. One strategy is to use dollar-cost averaging. This involves investing a fixed amount regularly, regardless of market conditions. This approach reduces the risk of investing a large sum at the wrong time. Over time, it can lead to better average purchase prices. For example, investing $500 monthly in an index fund smooths out market volatility. Pay attention to economic indicators like interest rates, inflation, and unemployment rates. These can provide clues about market trends. For instance, rising interest rates often lead to lower stock prices, while low unemployment can indicate a strong economy. Another tip is to avoid emotional investing. Fear and greed can lead to poor decisions. During market downturns, stay calm and avoid panic selling. Remember that the market historically recovers over time. In fact, the average bull market lasts 97 months, while bear markets average just 18 months. 12. Sustainable success. Ethical investing, or sustainable investing, aligns your investments with your values. Andrew Tobias discusses how this approach can lead to both financial and social returns. Investing in companies that prioritize environmental, social, and governance (ESG) factors can benefit society and your portfolio. One strategy is to invest in ESG funds. These funds select companies based on their performance in areas like environmental sustainability, social responsibility, and corporate governance. Studies show that ESG funds often perform as well as, or better than, traditional funds. For example, the MSCI KLD 400 Social Index, which focuses on ESG criteria, has outperformed the S&P 500 over the past decade. Look for companies with strong corporate social responsibility (CSR) programs. These companies often have better long-term prospects because they manage risks and capitalize on opportunities related to ESG issues. For instance, companies that focus on reducing their carbon footprint can benefit from lower regulatory risks and cost savings. Consider the impact of your investments. For example, investing in renewable energy companies supports the transition to a sustainable future and can provide substantial returns. The global renewable energy market is expected to grow by 8.4% annually from 2021 to 2028.